touched on the various types of snake oil that are sold by the financial media and financial product advertisers. These folks prey on the average investor's natural fear of stock market volatility, as well as her urge to chase the windmill of alpha, the superior timing and selection of her investments. This essential lie changes its narratives at various times depending on the current trends in the markets, but the pattern is very predictable. When you hear the following terms, watch your assets. First is the search for alpha, stock selection or market timing that outperforms the relevant benchmark. When that doesn't work, we'll give you equity-like returns with bond-like volatility, the myth of an inefficient market or of some guru with a black box. When that fails, absolute returns, in effect using a mix of strategies that are so varied and complex that they render any benchmark irrelevant. When that fails, how about lower volatility as somehow an end in itself? When that falls down, we'll give you uncorrelated returns, diversifying so wildly among strategies and asset classes which are supposed to be uncorrelated as somehow an end in itself. Then when a period like 2008 comes along, it turns out that everything is actually correlated. It's sad to think about how many times poor, unsuspecting investors have been induced to change the direction of their portfolios and buy yet another batch of incomprehensibly complex investment products before they realize that they've made a big mistake, even as the mainstream stock market continues to chug higher. In the end, the big lie, the malignant falsehood that volatility can be defeated even as your investor captures the returns he needs, is the ultimate betrayal of the investing public. That's because all of these mind-numbingly complex and expensive strategies are driven by the same toxic impulse, the fear of volatility and the failure to embrace the truth that temporary declines have no power to harm us in the long term. The truth is that equity returns must be earned, and they can only be earned by investors who are willing to hold them through the entire market cycle, which means having the temperament not merely to accept, but to embrace volatility. Thus we see yet again, the full return of equities is available only to persons of superior temperament, assisted, of course, in times of stress by a steadfast and disciplined advisor.